Hello, my name is Colin Szynski, Market Analyst with CMC Markets, here today to talk about trading opportunities in India's Nifty 50 index. There are a number of reasons why trading the Nifty has become increasingly popular around the world in recent years. First of all, India is one of the world's largest countries and economies, and it is large enough that people will take notice. Second of all, it's an emerging market similar to Brazil, Russia, and China. Because of this, it does have high growth potential and has had quite a strong growth record. It also tends to have higher volatility, which creates opportunities for trading. Thirdly, its sector weighting is a little bit different than some of the other emerging markets, and because of this, it tends to outperform other indices at sometimes and underperform indices at sometimes, giving people the benefits of diversification. Over the last 25 years, there's been a fairly clear, distinct seasonal pattern in trading India stocks. Now, stocks in general do tend to fluctuate throughout the year, and commodities as well. What's interesting, though, is that India's seasonality is quite different from that of other stock markets. Looking at the Dow as an example of the seasonality that tends to occur in North America and in Europe, we find that markets tend to start off the year fairly strong, rallying between January and about the middle of May. Late May and often June, we tend to see a correction and then a rebound in July. August and September tend to be the weakest months of the year for stocks in North America and Europe, and then they tend to finish the year quite strong. India, however, is a little bit different. Like other markets, it does start the year quite strong through January and February, but then tends to have a bit of a correction in March. Rebounds a little bit in April and May, and then tends to have a fairly sizable correction again in June. July, August, September, the summer months in North America, which as we can see are a little bit weaker normally in other markets, here actually are one of the strongest periods during the year, although we then get a correction in October, and then like other markets, India tends to finish the year quite strongly. What's interesting about this is that the seasonality of India is quite similar to the gold market as well as the Australian stock market. Looking at gold, the softer months of the year for gold tend to coincide with those of India. Now, in the case of gold, the declines have been fairly small, and we can really call them almost flat months for gold, but they are still similar to India in that the weakest months of the year for gold tend to be March, June, and October, and there is a reason for that related to demand for gold and how it fluctuates through the year, which we'll speak to a little later in this presentation. Also, the Australian market is also intriguing because it's very similar in that Australia is also a significant resource producer and is influenced a little bit by the gold market. And in the case of Australia, it tends to run about a month earlier, so it tends to have its softest months in February, May, and September rather than March, June, and October. And the reason for the seasonality in India, and also in gold by the way, is related to the changing of seasons on the subcontinent. There's three major seasons in India, and these are first of all the winter or the wetting season, which runs from November to February. Summer tends to run from March through May, and the rainy or monsoon season runs from June to October. The weakest seasonal months in India tend to occur around the changing of the seasons. So, for example, the weaker months here, March tends to occur right at the beginning of the summer, and then June and October are a bookend and as the beginning and the end of the monsoon season. The wetting season is particularly important also for the gold market, and the reason for this is that India is one of the largest consuming countries for gold, physical gold in terms of jewelry, and during the wedding season gold is often given as wedding gifts, so this creates a seasonal spike in demand for gold that's related to this, which is why the seasonality in gold and the seasonality of the Indian stock market tend to be quite similar. India's sector weighting is also a little bit different than some of the other countries and emerging markets. If we look at this table here as an example, we tend to see, looking at the world index on the far right, we tend to see that energy, industrials, consumer discretionary, consumer staples, and healthcare and technology all tend to be in the low teens in terms of weighting within an index. Materials and telecom services and utilities tend to all be below 10%, and then financials tend to run about 19 or 20%. Looking at the Indian market, the weighting in energy at 13% is a little above the global average. The weighting in materials is pretty close to the global average at 8%. 7% for industrials is a little bit on the light side. Consumer discretionary and consumer staples around 9 to 11% are fairly similar to the global average. Healthcare at 4% is quite weak. Financials at 27% is fairly high, although not as high as the 40% weighting in the Australian market. Information technology at 13% is pretty much spot on with the global average, although it is less than the weighting we find for the United States. And telecom and utilities are fairly similar. There are some interesting differences in sector weighting between India's market and China's market. In the case of energy and materials, we see that India is weighted 13% versus 8% for China, and this is flipped for materials, 8% weighting in India, 13% in China. China has a much stronger weighting in industrials, 17% versus 7%. India has a little higher weighting in consumer staples, 11% to 8%. Both are fairly strongly weighted in financials, 27% for India, 33% for China. Information technology is quite a difference, 13% for India, 3% for China. What's also interesting is if we look over at the Asia index here, we see a 20% weighting to information technology and only 13% for India. Something that's quite important to recognize for India relative to other Asia-Pacific markets is that India's telecom sector tends to be more centered on IT services, whereas other areas are centered more around semiconductors or hardware or software. So there are some significant differences between India and some of its comparable markets. And why is the sector weighting important? Well, because of its different sector weighting, on any given day, India's Nifty 50 may perform differently than some of the other indices in its region depending on how the underlying sectors perform. So if one day, for example, in early July 2012, the Asia-Pacific market reaction was as follows. We saw generally across the board slight declines, the Nikkei down 0.4%, Hang Seng down slightly, Australia down 0.4%, Shanghai down 0.2%, and Taiwan down 0.8%. Interestingly, however, on what was a generally negative day across the region, we had the Nifty 50 up 1.3%, and we had the Singapore Straits Index up 1.2%. What this means is that on any given day, you can be possibly trading the Indian Nifty 50 in a pair against some of the other markets in its region. In recent months, India's economy has been slowing down a bit, and it hasn't been running at quite the hot pace that it had in recent years. Q1 GDP was up 5.3% over a year, but this was down from 6.1% in Q4 and a 9% growth rate a year earlier. Purchasing managers has been relatively steady near the 55 level. Trade, however, has slowed. Exports in May were down 4.2% over a year. Imports were down 7.4%. The Indian rupee in early 2012 has weakened from 48.7 in February to 55.3 towards the middle of summer. Industrial production in April was up over 0.1%, which came in well short of expectations. The reason this has started to happen is that through 2010 and 2011, the Reserve Bank of India was very steadily and consistently tightening monetary policy and increasing interest rates in a bid to slow down the economy a bit and to cap inflation pressures. However, in April of 2012, for the first time, the RBI cut interest rates, signaling that it was switching from a tightening to an easing stance. Now, a lot of the people on the street had expected India to cut in June. They didn't do so. However, this could be due to the fact that most of the central banks did not cut in June. They were holding off in case they needed their firepower for later. Into July of 2012, we've seen a number of central banks around the world easing monetary policy, cutting interest rates, and this includes the Bank of England, the European Currency Board, the China's central bank, also South Africa's central bank and Brazil's central bank have all been cutting. So a lot of the emerging markets have been cutting. It is possible that heading into the latter part of 2012, we may see India's central bank take a more aggressive easing stance as well. Looking at how these can impact trading in the Nifty 50, we would direct you to the technical updates that appear on our chart message boards frequently. Technical comments from our analysts and clients are available on India's Nifty 50 on the next-gen SpreadBet and CFD trading platforms. These are updated regularly, so we encourage you to go on there, see what our analysts have to say, ask them questions, and also to post your own thoughts and join the conversation. To access the chart message boards, you need to have a live spread bet or CFD next gen account with CMC Markets, and to start it up you need to have a balance of at least £1,000 in order to activate the feature. We'll conclude with our risk warning. This video is for general information only and is not intended to provide trading or investment advice or any personal recommendations. The information in this video is indicative and may become out of date at any given time. CMC Markets shall not be responsible for any loss that you incur either directly or indirectly arising from any investment based on any information in this video. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Losses can exceed your initial deposit. We therefore recommend that you seek independent advice and ensure that you fully understand the risks involved before trading. You do not own or have any interest in the underlying assets. CMC Markets products are not available in the United States or any other jurisdiction where they are not permitted to be used or provided. We highly recommend that you practice trading using our demo account before you open up a live account. And that concludes our introduction to trading on India's Nifty 50, and we encourage you to visit other videos in this series. Thanks and have a great day.